Well, hi Peter, how are you? So nice to see you again.
So nice to see you again, Bogomil. Doing well, and I hope the same goes for you.
All is well. I got to see you in person not long ago in Omaha. You
hmm
were giving a talk at the Gabelli conference with a whole panel of Berkshire experts. I got to see you there, and then we spoke during some of the private events as well. So it was fun to actually spend time with you, and I get to know people through this virtual experience, and then I get to see them in person. We got to spend quite a bit of time in clusters this year, and then I had this blessing of seeing you in Omaha. So I'm very grateful we got to do it. But in between, you came up with a book, which I'm really happy to see because all the writing you're doing, all the research you're doing, and all the content you're sharing with the public, I thought that this belongs in a book. And you were kind enough to share with me an early copy, and I read it right away. And then I was thinking, I had so many highlights and so many questions, and I thought I have to limit myself. So let's jump right in. And the first question I have at the beginning of your book, you offer a beautiful summary of your investment philosophy. And I'm thinking for those of us that will be with us today for only a few minutes, and these are the minutes I would love them to hear. What's
hmm
the philosophy in a nutshell?
Sure, but before answering that question, Bogomil, I want to say you are probably way too kind, and the honor is all mine in having had the opportunity to meet you, to meet you. And indeed, it was an amazing time in Oma, and hopefully we can expand or even expand our friendship in the years to come, and build on this because as you know, as I know, as we all know, probably compounding also works in knowledge and friendships and so on. So I'm
Very much
feeling
so.
honored to have met you.
Thank
Um,
you.
the honor is mine. So regarding your question, so you are right. So the Art of Quality Investing has been published 3 weeks ago now. So why did we publish the book? Because credits to those who deserve. Well, I worked on it together with Luc Kroeze, a great friend of mine. We felt that a lot had been written about value investing, all the things about Benjamin Graham and so on, about growth investing with Phil Fisher. But quality investing is, at least relatively seen, probably still quite new. So what we wanted to do with the book is trying to provide an entire framework for quality investing. So when you read the book, that you know what quality investing is, how you can find these kind of companies, how to think about valuation and so on, that you can basically do it yourself. It's some kind of do-it-yourself manual for quality investing. Now, before I bore everyone listening, so for those who only have a few minutes to listen, while quality investing, when you ask 10 different people, you probably get 10 different definitions about quality investing. But to me, it's all about investing in the best companies in the world. So using three steps there, based on Buffett on the one hand, obviously Warren Buffett, and then Terry Smith on the other hand, was first point, buy wonderful companies, so great businesses. Second point, you want those wonderful companies to be led by excellent managers, so managers with skin in the game and so on. And then third point, obviously wonderful companies, quality management. The market often recognizes that. Then it's the art of quality investing to pick up those stocks at fair valuation multiples. So I think that's the essence of quality investing. And maybe one thing I want to add, because like you mentioned, we are just back from Omaha. I talked about it with Chuck Yeager, who was also just like you, just like me at the event of Francois Rochaud in Omaha. And he also mentioned that, well, for example, we all know Warren Buffett, he's really good. Why? Well, Warren Buffett to me is a quality investor, but why do you want to do it yourself? What is the main advantage you have? Well, the skill set of, at least I'm talking for myself right now, but the skill set of mine is way lower than the one of Warren Buffett. Well, two things we have two advantages right now. One is hopefully time, because Warren Buffett is 93 right now. I'm 27. I'm not sure how old you are, Bogomil, but definitely not 93 already.
Not yet.
Uh, and then I was also discussing that with Chuck Yeager and also at dinner with Team Fundsmith at Goratz. The main advantage we still have is obviously you don't have billions of dollars to invest. So when you can try to implement the quality investment philosophy more in the small and mid cap space, so market leaders in a niche market and so on, companies with still plenty of room for growth, well, can be something really powerful, because it was also Buffett who said, anyone who says that size doesn't hurt performance is selling. Well, that's exactly true, and we can still invest in those small and mid cap companies, so that can be something really powerful if you can find a real quality business there.
You're touching on so many things that I want to come back to. But before we talk about the book, you brought up the co-author of the book, who had a big influence on you. Can you talk about him and what's the backstory?
Yeah, sure. So I always joke with the basically, credits to those who deserve. Luc is the author of the book, and we work together on it. But for me, it's more the compounding quality behind it. So Luc is a great friend of mine, and I always joke with him. Well, what Benjamin Graham is to Buffett, you are to me. And to understand the story, we probably need to go back a year or 5, something like that. I live in Belgium, and basically when I was still studying financial management, my entire portfolio, or almost my entire portfolio, was invested in Belgian companies. Then I joined the asset management industry, an asset manager in Antwerp. But basically they said to me, okay, you can't own any Belgian companies anymore. Why? Because with the funds we were managing, I was on the buy side, you could influence the stock price. So to me, this basically meant that I needed to sell my entire portfolio. In hindsight, I think that is a very good thing. Why? In Belgium, it's not a large market, only around 1 or 20 companies. So I needed to rethink the investment strategy, and that's basically when I start to really get into quality investing. So reading books from Cunningham and so on, reading Terry Smith, but also, Luc Kroeze is a great friend, has become a great friend. So back in the days, we probably, for 3, 4, 5 years, we talked about quality investing daily. So discussing those things, I learned a lot from him, because he already had more experience than I had, and probably without Luc, it would take me plenty more years to figure everything out myself. So having a good mentor in life and in investing is probably a very good thing. So we talked daily. I felt like there was a match, is the right partner. And Luc decided to write a book about quality investing in Dutch, which is called, probably a hard word for English native speaking people, but it's called the caveat formula. So I really liked the book. I loved the book. And that's when we made a partnership to publish the book together in English, basically. And also maybe to mention here, obviously, you would never do something like that when, one, you don't respect the author, so you don't respect Luc Kroeze. I do respect him a lot. I look up to him. And second part, I think that what's in the book, it's a very good framework to invest successfully in quality companies, in wonderful companies. So that's how the partnership was formed. And I've been really grateful to have met Luc and to have him as a partner right now.
So reading your book, I told you that I had so many notes and so many questions, but something that hit me very early on in the book. In my career, I've come across investors who are drawn to complicated investment cases. I mean, the more layers, the more stories, the more stones to be turned, the more excited they get. And I always lean towards the simpler cases, I call it the thinner folder kind of investment case. And you propose that kind of view as well. You want companies that are easy to understand. And that's, as you can imagine, music to my ears. Can you talk about that, why it's important to you?
Yeah, sure. I think the most important thing there I start noticing is when I worked in the asset management industry, I always felt like the dumbest guy in the room, which is actually a very good thing, because in that case you can steal with your eyes and with your ears and learn a lot from them. But the other question I asked myself back then is, those guys, or women, obviously also possible, they are so smart, they're working 70, 80 hours per week, looking for stocks basically. And yet, when you look at the data, probably 90% or even more underperforms the market. So,
Right.
question I ask myself in that case is, well, why would I be different, right? Because those people are way smarter than I am. And I think the way you can be different is to use a very straightforward, very rational investment approach and to keep things simple. So I always love to keep things simple. And obviously there are multiple roads that lead to heaven. But when you look at the data, there are plenty of investment strategies that are very straightforward, I guess, that make a lot of sense and that tend to do better in the market. So that's what I'm trying to do as well. So trying to be as rational as possible and use a strategy like, for example, companies with a moat outperform over time. Just buying, you have on the background, you will see, for example, somewhere stocks for the long run from Jeremy Siegel. Well, buying the cheapest PE stocks outperforms the market. Buying stocks with good momentum in general outperform the market. So I think it's important that you, one, choose an investment strategy that works, and then second point, well, one you feel comfortable with, because there is a famous saying, well, you can borrow someone's ID, but you can't borrow their conviction, right? So that's a very important one. And when you invest in a company that you don't understand, well, in that case, if you ask me at least, you are almost guaranteed to fail. Why? Because you don't understand the business. When something changes in the industry and so on, well, you won't understand what is changing. So staying within your circle of competence is definitely the most important thing. So you need to understand obviously how the company is making money. And then second part, well, also be able to probably make an educated guess about how the company will look like in 10 years, how the business will look like in 10 years. So I think that's very important. So always keeping things simple, using your gut feeling and using rule of thumbs to make investment decisions, because the more assumptions you make, well, the trickier it gets, because that's the same for discount cash flow model, for example. Well, you are making so many assumptions, and when you change the discount rate by 1%, for example, well, the output or the outcome is completely different. So
Right.
keeping it simple. And probably one last thing to add here, we all know Peter Lynch. Well, he also said, well, try to explain your investment idea to a 13-year-old in 90 seconds or in 2-3 minutes. And when even the 13-year-old can understand the investment rationale of your thesis, well, in that case, it makes complete sense. And it also shows that you understand the investment case. So I think keeping it simple, staying within your circle of competence, was the essence of investing. It's the basics, and it's so crucial. And yet so many people are skipping this step. But by skipping this step, well, you increase probably your chances that you will make mistakes.
And I want to emphasize that simple doesn't mean easy.
Mm-hmm.
Sometimes explaining something that seems to be simple, it's actually the hardest thing to do, to actually break down the business model in a way that in a short period of time you could explain to somebody, why does this work? How does this company make a profit? Why it's valuable to customers? How they can increase pricing year after year and so on. When you think about it, breaking it down, and Buffett and Munger have done it over the years for us, for the audience that they attract. By the time you break it down, a lot of work has been done to get to that point.
Yeah,
But
exactly.
I like the idea of a thin folder, and I had a conversation with Chris Mayer on the show, and I think the person was Sosnov, one of the investors back in the day, who had this idea of physical folder, that the thinner it is, the better, just so that it doesn't take a lot to explain, because there are fewer places for trouble to hide. The kind of investing that I do, as you know, I manage money for families. It's a long-term patient capital with kind of an infinite investment horizon. So I look for businesses, you call them quality, but also that have a runway to go. And I want to bring back Peter Lynch, who you just brought up. He had this idea in his books that if a product or a service works in one state, you can roll it out and have it in multiple states. And really spoke to me. US is a big market, and I saw this opportunity how you could roll it out everywhere. You
Hmm.
take it to the next level. You talk about companies that can go global. And I find it really interesting because not all companies will become global, but if they do, they have this open-ended, almost infinite opportunity in front of them. Can you talk about it? How do you find those? Why do you pay attention to that global opportunity of you call it a diversified customer base that they can have? Why does that matter?
So basically, in the book, how the book is outlined, we give a few qualitative criteria. So qualitative criteria that quality companies or wonderful companies match, and then afterwards also some quantitative criteria. So being well diversified, so geographically, but also regarding the customer base and so on, is one of the qualitative criteria. Well, I think the essence is very simple. And you touched upon that already. Well, it was Charlie Munger who said investing is simple but not easy, right? But yeah, the essence probably there is diversification reduces your risks, and it's the same for the number of stocks you own within your portfolio. But that's also exactly why, in an ideal world, we want geographical diversification as well as a good diversification over many customers. Why do you want geographical diversification? Well, obviously, when a company is active in the US, Europe, and Asia, for example, compared to a company that's only active within Asia, well, we can assume certain growth rates. Let's say GDP growth for the US and Europe is 3% and a bit higher for China or for Asia, like 4 or 5%. Well, in that case, you could say, okay, we should only look at Asia because the expected growth is large there. But what we what we probably underestimate in that case is that in the stock market, but also in the economy, everything is highly volatile. So what you want is by diversifying over US, Europe, and Asia, well, you offset the risk that tomorrow or next month something in Asia will happen and the market goes down there. So having a good diversification also from a geographical perspective is crucial, because when
Right.
only one black swan event needs to happen, and it can be really harmful to your returns. So also the saying from Buffett, well, rule number one, don't lose money. Rule number two, well, you know that Bogomil, don't forget rule number one.
Yeah.
So is it a no-go when a company is only active in the US or Asia and so on? No, it isn't, because obviously, hopefully, you own multiple stocks within your portfolio, and when you look at your entire portfolio, probably your diversification will be quite well from a geographical perspective. But yet, when we could choose, well, a good geographical diversification would be important. Same goes for client concentration or customer concentration. You obviously don't want a company where 50% of their revenue is linked to one customer, because when that customer then decides to choose another supplier or something happens to them, well, that causes a big problems for them. I think about a company I'm looking into right now, Interparfums. It's a US company. I think a year or 10, 12 ago, well, one client accounted for 50% of their revenues, and well, they decided to go on their own. Well, obviously, that is really harmful for the business. For Interparfums, everything ended up well in the end, but that's something you want to avoid. And maybe what I want to add here is also regarding how many stocks you own in your portfolio, for example. I think the more experienced you are, well, the less diversification you need. But in the beginning, well, you will make plenty of mistakes. And that's why diversification is crucial. When you only are invested in 5, 6, 7 companies and one goes into bankruptcy, well, obviously that's really harmful for your returns. So for me personally, probably looking for 15 to 20 stocks in my portfolio.
So when I think of investing, to me, it's one side is obviously, the returns. Can we compound capital at a respectable rate? And the
Mm-hmm.
second thing is, I call it, how is the journey? And here I mean, people look at those zoomed out long-term charts that show an almost even out line for equities that they have gone up over the history. But when you zoom in, there are some periods that were very difficult, especially during all kinds of crises.
Mm-hmm.
And to have a portfolio that you can actually hold on to through times like that. And the fresh memory these days is still, to me, March of 2020, when I took a lot of calls from clients, and I realized that the way you build the portfolio really matters, right? So if you have a handful of stocks that move up and down a lot, it doesn't matter in the long run, but there are periods when you have a massive drawdown and it's financially painful. And I think psychologically, I think that part is very difficult. And the last minor thing I want to add, but I think it's very, very important, is when you look at the portfolio, I tell clients it's not just what's in the portfolio, what kind of stocks we have, but also the things we chose not to have.
Absolutely.
And these are the things that don't really matter too much most of the time. You could get away owning some stocks, but then in moments of true distress, these things can really hurt you, right? So I think these are the two sides of looking at it.
Exactly. You can probably make two kinds of mistakes, right? Owning a stock which tends to be a wrong investment decision in the end, but also you can indeed choose not to invest in stocks, but which ends up to be a really good one. So it's also important to keep that in mind, and probably the psychological aspect is way more difficult than you can say that you will act rationally when the market goes down 50%, but to actually do that is another completely different thing.
Even for the most experienced people, I think it's very hard. I have another question about valuation and growth, but before that, you said something a few minutes ago that really it's an important revelation that I share with you. You said how you felt that you're not smarter than the people in the room. And I add to it and I say, I'm not faster than anybody else. I don't make that claim that I'm smarter or faster than anybody else. But I say that I'm probably more patient than an average investor, and probably than most investors. And I think that's the hidden advantage that we can have. And it depends on the kind of clients you have. But if you manage, patient family money over multiple generations, it's very patient capital. So we can actually wait to buy. Absolutely. But the bigger part to it is that we can wait to see the full potential. The kind of quality stocks that you write about in your book, they will take time to fully deliver what they have to offer, right? And here I want to talk about this idea that you bring up in your book, that you could get a multiple of what you invested. And a lot of investors are focused so much on valuation. Even today I had a phone call with somebody, and a lot of the words that came up, this is cheap, that's cheap. And to me, that's good, but it's very static approach to investing, that you bought something cheap that can maybe, that's the proverbial dollar that you buy for 50 cents. But I'm curious if that dollar could be 10 or 20 or $50 down the road. And that can only happen if there's growth. Can you talk about the importance of growth in the kinds of investments that you are intrigued by?
Sure. I loved what you said about that you are more patient than the average investor, because obviously in general you can probably have three advantages, right? You can have an informational advantage, an analytical one, or a psychological one. Well, an informational advantage in today's market is probably really difficult, given the internet, AI, and so on. Analytical advantage also quite difficult in today's markets, I guess, especially in large caps, because so much has been said and written about Microsoft, Apple, and so on. But the one advantage you mainly have is probably the psychological one. And one thing I'm really happy about from going to Alma again this year is that I picked up another copy of Poor Charlie's Almanac there, and I was reading it this morning, and it's just it's some kind of a Bible for rationality. So probably when someone who was listening didn't read it yet, well, probably a book that you should reread every year, because obviously, Charlie has led a phenomenal life. Now, to get back to the valuation aspects, well, I agree with you, and it's completely naive, like what some people still state, that a company with a PE multiple of 10 is cheap and a company with a PE multiple of 25 is expensive. Well, obviously that's totally not true. It depends on so many factors, and the quality of the business, the outlook, and so on. And I would say that's a fundamental difference between value investors and quality investors. So a value investor tries to find a stock that looks cheap, an undervalued stock. He buys that one, and once the undervaluation hopefully disappears, well, he needs to sell the stock because the undervaluation disappeared, and you need to find another undervalued one. So in that sense, value investing is a way more active strategy than quality, because you need to do that again and again and again. And with quality investing, you might pay a multiple that looks quite high on first sight, but it's a great company, it's a wonderful company, so the intrinsic value per share grows at very attractive rates. And in the end, well, the stock price will follow. So for value investors, it's valuation first and then quality second. But for quality investors, it's quality first and then valuation second. And we also know that, well, what drives stock prices in the short term, so in 1 year or something like that, well, probably the sentiment in the market and the changes in the valuation, so the multiple expansion and multiple contraction, can be quite high, because in a single year, well, the change in valuation and so the change in the stock price can be up to, or on average, be 50%. So that's a lot. But so in the short term, changes in valuation, but in the long term, well, stock prices are always driven by the evolution of the intrinsic value. So that's something that is really interesting, if you ask me. And when you then go one step further, well, what drives the evolution of the intrinsic value? Well, Buffett said, well, the value of a company is all the future cash flows that they will still generate, well, discounted to today. So free cash flow is really important for the valuation of a company. So when a company can grow its free cash flow at very attractive rates, well, in that case, the intrinsic value should grow, and eventually the stock price will follow. So that's also why, as a quality investor, you look for companies active in a secular trend like obesity, digital payments, urbanization, and so on. So that's something really important. And also, well, probably most of us will have done a discount cash flow. And obviously, when you do a discount cash flow, well, the cheaper the company, the higher the upside, or the higher the undervaluation, right? But what is important to understand for quality companies, what is important to understand for wonderful companies, is that those companies are often so good that they can grow at above average rates for very long periods of time. So in a discount cash flow, usually you do a DCF for 10 years. You project the cash flows for the next 10 years, and then you use a constant growth rate. Well, what you see often is that those kind of wonderful companies, those kind of quality companies, they can grow at above average rates for 15 years, for 20 years. And what is important to understand is that when you would create a discount cash flow for 15 or 20 years, well, probably every company is undervalued in the long term. Obviously, it's really dangerous to make those kind of assumptions, right? But yet, I think it's very important to understand that this is the case. Take, for example, S&P Global. Well, they have been growing at very attractive rates since the 80s. So that's more than 40 years by now. So that's probably the power of quality. As long as the moat remains, well, those companies will continue to thrive, probably, even when the valuation in the short term, well, looks quite expensive.
Yeah, it's all an interesting point, and I think it brings it home for me in the sense of, why would you own stocks to begin with, right? And I see this as ownership of businesses. Why would you own a business? Well, you would own it for the profits. What about those profits? Well, they have to be sustainable and they have to grow over time. And you kind of, layer after layer, you realize, if you move aside completely the daily price movement, the tickers and all the noise, right? All of it is an opportunity for us to own pieces of businesses. And then what kind of businesses, and when would you buy them, and how would you hold them? There are a couple of things that I wanted to add. You know, there are certain challenges to the approach with quality businesses, I realize. One of them is that actually holding them for long periods of time, I think it's easier said than done. And I think the biggest immediate test for a lot of people is what I call a year or two, or sometimes longer, when the stock is completely dead money. And even if you pick on the most successful quality businesses, highly recognized these days, you'll see that they had a year or two when the stock didn't move anywhere. And these are the moments when a lot of less patient investors would leave.
Mm-hmm.
And then you have this massive opportunity that follows. I had a fascinating discussion with John Rotonti, who you might know, who was at Motley Fool for many years, and how we want to think that businesses are linear in the sense that you can put it in a very firm, rigid model and say it's 3%, 10%, 12%, whatever the growth rate might be. But companies go through those leaps and pauses where they enter a new market, or they move from desktop to mobile, or they move from just domestic to international, or they move from 2 product lines to 6 product lines. And that's not linear, right? But in those moments, it looks like a pause. And obviously, some companies after that pause start to decline and shrink and go away. So that's a trap. But some of them figure out a better way to do business and do it in a different way, and maybe in more ways, and so on. And one of the tricks is the pricing power. So the next question I have for you is about pricing power. It's something that I don't think a lot of people think about or talk about. Maybe it was brought to our attention more these days with a bit of an inflationary environment. But the big picture idea as a business, when you operate, it's a very competitive endeavor. If your prices go up, but your competitors don't do that, you might be losing some business. You have to have this very sticky, loyal customer base that's willing to accept a price increase. Can you talk about the pricing power, what a magical force it can be in the long-term success of businesses?
So obviously in the investment strategy of quality investing, the one thing, or the most favorable thing you're looking for is probably, well, quality companies with plenty of reinvestment opportunities. But what we need to understand is that those companies are very rare, in the sense that those companies are so profitable, they are pouring out so much cash, that after a while they just don't know what to do with the cash they earn, and they don't have, well, organic reinvestment opportunities anymore, and they start to pay out dividends, start to buy back shares, and so on. So take companies like Apple, take companies like MasterCard, and so on. You see that they bought back quite some shares over the past, but it's just because they don't know what to do with the cash they are earning. So quality with plenty of reinvestment opportunities is probably the most preferred thing. It's how compounding machines are created. But then maybe the second favorable kind of stocks are those with pricing power. So, well, the essence, what is pricing power? Pricing power is probably that a company has the ability to raise its prices, and without losing customers, or without losing many customers. Think about See's Candies, for example. Well, Berkshire bought it in 1972, and since then they have raised their prices every time after Christmas. So that's something very, very beneficial. Why? Because pricing power is actually a source of growth, but it's a source of growth where the company, well, basically doesn't need to invest in it. So, for example, when you have a cookie company and they want to grow, well, they need to build a second factory, they need to hire new employees, and so on, to sell more cookies. But when a company has pricing power, they just increase their prices, and for the rest, it doesn't take them any effort, and they can grow by 3-4%. So, for example, just before we started this conversation, Bogomil, I was at a call with Games Workshop. It's a UK company, miniature games. Well, they have been raising their prices by 5% on average over the past 10 years. So that also means that our top line, so the revenue, grows by 5%, and then hopefully
Right.
a good business has some operating leverage. So that means that they can grow their bottom line by 7-8%. So that's something that is really attractive. And pricing power, by the way, is also a very good protection against inflation. So inflation was obviously a very hot topic over the past few years. So those kind of companies, well, they didn't suffer as much as commodities or cyclicals and so on. So maybe to add here, well, how can you recognize a company with pricing power? Well, those companies are often characterized by very sustainable and high gross margins. So you have companies like Games Workshop, S&P Global, and Moody's have a lot of pricing power, and that's interesting. Something that's also very interesting to see is that when you look at the portfolio of Warren Buffett, for example, the portfolio of Berkshire Hathaway, you will see that plenty of those companies also have a lot of pricing power. And I'm paraphrasing here, but Charlie also said something like, well, when you have a company that has untapped pricing power, and with untapped pricing power, he meant that the company had pricing power, but didn't use it into its full force yet. Well, that is one of the most wonderful things for an investor, and that are the kind of companies you need to look for. So that's also something we are talking about in the book, and where I'm very interested in personally.
I have a question about returns, but before
Yes,
that, I just wanted to mention for the benefit of the audience, any stocks that we bring up in this conversation, they're just illustrations, no
absolutely,
recommendation. So
absolutely.
do your own research and see if any of those would belong in your portfolio or not. But I want to ask about returns because you brought it up,
Every
and I think
company I talked about are short IDs, so go ahead with that.
do your own research, whoever is
Exactly.
listening, or talk to your advisor. But I want to ask about returns because you brought up something really interesting. A company that has a beautiful business in the sense that it has nice margins, nice cash flows, doesn't need to reinvest too much in the business, starts to collect cash.
Mm-hmm.
And in some ideal situation, they have ability to redeploy that at very respectable rates back into the business. And I think that's the best situation you can have.
Mm-hmm.
I mean, in very simple terms, we talked about Peter Lynch, and I have this image from his book from years ago, how you have a retail concept, a store concept that's successful in one part of the US, and then they redeploy almost in a self-funded way, a rollout of those stores, coast to coast, right? That's
Mm-hmm.
one idea. But there are other ideas in more asset light or service businesses when you roll it out to more markets, more people. But they reach a certain point when they can't find enough of an opportunity to redeploy it. And then we start to pay more attention. How is that capital allocated? Are these dividends, buybacks? If they're acquisitions, what kind of acquisitions? So that's really important. And one last thought here, and you bring up Charlie Munger quite a bit, so let's bring him up again. He says that in the long run, the return you can get in a particular stock is the return on the capital that they get on the money they reinvest. I think it's a very powerful revelation, right? Like people are trying to figure out, well, how much I can make in this business. Well, if you have a business that's successfully reinvesting in itself and at 25% rate, and there are not too many of those,
Absolutely.
then over the long, long run, it will be tricky to get a higher number than 25. Obviously, it can be driven by valuation expansion over a short period of time, but over the long, long run, you will get somewhere close to the returns on the capital that they get. I think that's something that's worth thinking about. You have some thoughts about the returns?
Yeah, absolutely. So you have the saying like of Charlie, like you mentioned. So if you buy a business with a 6% return on capital and you keep it for 25 years, well, your return will be more or less equal to 6%, even if you buy it at a huge discount. And then the other way around, well, if you buy a company with a return on invested capital of 18% and you keep it for 25 years, well, you will end with one hell of a result, even if you buy it at a very expensive looking price. Then we also get back to the valuation discussion. But what's important to highlight here probably is that what Charlie states is true, but it's only true, the statement that you get an 18% return with a company with an 18% return on invested capital. That's only true when a company can reinvest everything back in the business. And that's, like you mentioned, very, very rare. Those companies are you need to dig really deep. And I found 2 companies that can still reinvest plenty of their free cash flow in the business, again at attractive rates. But they are very rare, and most companies are so profitable, so good that after a while the organic growth opportunities are gone. And then when you have a company with a return on invested capital of 18%, but they don't have any organic growth opportunities, so they can't reinvest anything back in the business, well, in that case, it's the return on invested capital isn't valuable at all. So that's something important to understand probably. And an important side note to the quote of Charlie Munger.
Somebody brought to my attention this study, and I'm forgetting who and what the context was, but the big lesson from it was that when you ask CEOs if you would choose sales growth over returns on capital, which one is more meaningful to you? And we are so driven by the top line growth and earnings growth. And obviously there are incentives in place that make it even more obvious that that's where a lot of managements are leaning towards. And the sooner you can deliver those, the better. Then we forget about the returns, right? So you could add a whole billion in sales that will bring very little in profit and will have very embarrassing returns. But we're focusing on that top line. Look, I added $1 billion in sales. It's more nuanced than that. You have to know what kind of margins that billion comes with, and then what kind of returns you're getting. And I think a lot of the discussions could be more layered, not just the top line, but what kind of returns are you getting on that investment back in the business?
Yeah, it's a very important point, and we also talk about it in the book. And as a rule of thumb, to get right to the essence, the question, should a company focus on growth or should it focus on capital allocation, about return on invested capital? Well, basically, the lower the return on invested capital, the more important it should be for management to work on increasing the return on invested capital and leave growth a bit on the side. On the other way around, if a company has a very high return on invested capital already, well, it makes more sense to focus on the growth part. So here also to understand, when a company would increase its return on invested capital from 10 to 20%, for example, it would be way more valuable than when a company would increase its return on invested capital from 50% to 100%. What's the reason for that? Well, when you are calculating your reinvestment rate, you basically take your growth rate and divide by the return on invested capital. So let's say a company wants to grow by 10% next year, and they have a return on invested capital of 10%. 10% divided by 10%. Well, that's 100%. They need to reinvest everything back in the business to grow by 10% per year. If this business can increase its return on invested capital from 10 to 20%, you once again do the growth rate divided by return on invested capital. 10% divided by 20% is 50%. So now they need to use 50% of their free cash flow to grow by 10% per year, and 50% can be used for dividends, share buybacks, deleveraging the balance sheet, and so on. And when you have the other example, improving your return on invested capital from 50% to 100%, well, let's say the growth rate or the growth rate you want to achieve is still the same, 10%. Growth rate divided by return on invested capital, 10% divided by 50% is 20%. So they can use 80% for dividends, share buybacks, and so on. But when they would increase their return on invested capital from 50% to 100%, well, it's 10% the growth rate divided by 100% return on invested capital is 10%, and you can use 90% for other things. So in other words, well, in that case, you only save or have 10% of your free cash flow extra from dividends, share buybacks, and so on. Whether in the first example, well, it goes from you need to have or reinvest everything back in the business to grow by 10% versus 50%. So that's a huge difference. So yeah, to recap, the lower your return on invested capital, the more a company should probably focus on that. And the other way around, the higher return on invested capital, the more managers should probably be focused on maximizing the growth of the business.
There you go. The little catch here is that when the management is deciding where to put the money, it's not exactly that they go to a supermarket with very clear prices that say this is a 5% return, this is a 20% return. That's one thing, right? So we don't always know. And second thing is the timeline of those returns, right? There are some businesses, pharma comes to mind, where you invest capital and you commit time and resources, sometimes for a decade, to develop a new medication, a new treatment. Or even tech companies these days are developing the next generation of the product that takes time. And you don't know what the returns will be, right? So, but the fact that the management is even thinking about it, I think it's a huge plus already.
Absolutely.
that they are even considering it. And it's not science in the sense that you can say this project is for sure going to bring
Hmm.
22.5% return. We don't know, but at least we're aiming in a certain directionally. We're more and more correct. I think that's a great way of looking at it. And
And
truth be told is that the biggest value creation happens over time. So it's a certain alignment, right? And clients that think long term, you as an investor that thinks long term, and businesses that think long term. Some of the biggest opportunities for the businesses that you would call quality these days will find those opportunities far down the road. It's a 5, 10, 15-year plan of entering a new market, reaching a scale, and so on, right? It doesn't happen overnight. Yet we try to gauge their success quarter to quarter, as so many of the investors do, which is a huge disconnect that we can't really close that gap. Peter, I want to ask you about something that's in your book that made me really think how when we look at different industries, there are some industries where there's a lot of players. Nobody has a leading market share. Everybody's a price taker. Nobody has the pricing power. And it's a place where we don't want to be. I choose not to operate in those. They're hard.
hmm
They're very cyclical. They probably use a lot of leverage. These are tough businesses. That's how I would describe them, difficult. And then you have some industries where you have one or a handful of players that dominate the market. The dynamics shift, something interesting happens, and a lot of the things you bring up that you consider quality start to line up. Can you talk about the bigger picture makeup of an industry? Fewer players, more rational pricing, and sometimes maybe one player that really dominates the whole industry.
So for me personally, and this is not investment advice, just how I'm doing it. So do your own due diligence. But for me personally, I'm using three buckets for my investment portfolio. So you have the owner operators, so wonderful companies still led by their founder and so on. You have the cannibal stocks, so a term popularized by Monish Pabrai, so quality stocks that are heavily buying back their own shares. And then third bucket is the monopolies and oligopolies. So those are companies that are, where only one or a few companies dominate the entire industry. Often
Mm-hmm.
very attractive. Why? Because, well, one, the fundamentals are often very attractive. And second point, they often have a lot of pricing power. So that is something that's a very interesting niche, and there isn't much competition and so on. And the interesting thing there is also, um, well, when you look at the portfolio, the current portfolio of Buffett, but also all the stocks he owned in the past, you will see that almost all those companies are monopolies or oligopolies. So if even Warren Buffett looks at them that way, well, probably can make sense for us to do the same as well. So I'm not looking into buying cyclicals, commodities, but really companies with a moat, companies that do something unique. So as a quality investor, you are not trying to invest in the next big thing, but in companies that have already won. And like I said, well, this morning I was rereading Poor Charlie's Almanac from Charlie Munger, and he also mentioned it there in one of his speeches. What's the reason, for example, that some industries are very rational regarding their pricing and so on, are very profitable, and other industries, well, they aren't, and they are just the competition is so large that basically the margins for the entire industry go down. I think that's something very interesting, and he gave the example of cornflakes, for example. It's a very profitable business. Well, what's the reason? Well, what's the reason for that? I think it's not that difficult to produce cornflakes, right? But it's just how the industry dynamics work, and in some industries they were completely different than in other industries. So there I think it's really important. One thing to probably, the monopolies and oligopolies are often very, very attractive, and to just look at the track record of the industry, for example, for cereals, for cornflakes, well, this industry has been really profitable for over 50 years, and probably won't change anytime soon. The same for toothpaste and so on. And when you compare that with industries that are operating at very low margins, that maybe sometimes even go into red, which are not making a profit at certain times because the new competition is entering and so on, well, that's something you definitely would try, or I would try to avoid, to invest in those kind of businesses.
You know, a business is like a story, like a novel, right? It's reveals itself piece by piece.
Mm-hmm.
But the more books you read and the more companies you study, you start to see that those stories rhyme. And it's no surprise. You know, I did this exercise years ago with one of my interns, and I would say, let's take away the name of the company. I don't want to know the name. Just show me the statements, financial statements. And I showed him how to read it and how to see where the margins are, what the
Mm-hmm.
returns are looking like, how the cash flows are shaping up, if there are ups and downs in the business, or if it's a steady grower. And I could tell what kind of a business it could be. I can't guess the name. You know, the sizes, if you show me the size, I'm going to guess this is this
Mm-hmm.
company because there's no other company that has this much in sales in that particular business.
Mm-hmm.
I can guess by now. But he was fascinated that you could actually figure it out, that it's no surprise after a while. It's almost like that. You know, I grew up in a household with two doctors,
Mm-hmm.
physicians. And for us, when you have a certain ache, it's a mystery. But for a doctor that sees people every day, a lot of things are no longer mysteries. And I think that's the same with stock research and investment process. We don't know the future, nobody does.
Mm-hmm.
But in terms of actually evaluating what kind of businesses you'd like to own and why, you can figure it out over time. And that's the puzzle solving aspect of it, the intellectual pursuit that I find fascinating. You know, the more businesses you see, the more answers you can find. Peter, I want to ask you about the management. And the reason I want to ask you, I like this idea that we buy the business, but we get the management.
Mm-hmm.
The reason I phrase it this way, because in the public markets, most of us will become minority shareholders. And there's nothing wrong with that. I think there's certain beauty to it that
Mm-hmm.
we're treated equally. So I'm not going in and changing the management. I kind of get the management. I like it or I don't like it. But the management, these are the captains that will steer the ship in a certain direction. And they have to be capable. How do you think of evaluating a management of a company you're about to buy?
Yeah, sure. So first of all, I would mention, well, probably the quality of the business is more important than the quality of management. But
Mm-hmm.
remember the three rules for quality investing: wonderful companies, excellent managers, and then trading at fair valuation levels. So management is still very important. And that's also why, for me personally, probably 70% of my portfolio is invested in companies where there is skin in the game. So where the founder is still involved, where it's a family business, and so on. And why? Because once again, I'm not as smart as all the professional investors and so on. But we know that when the company is skin in the game, you increase your chances that the incentives of management are aligned with the ones of you as a shareholder, and incentives are very, very important. So show me the incentive and I'll show you the outcome. That's exactly the case. And you also have a study from Harvard Business Review, for example, that states that companies, founder-led businesses, outperform the market by 3.9% per year on average.
Mm-hmm.
3.9% per year. Basically, when you would achieve an outperformance, an annual outperformance of almost 4% per year, you will probably do better than 99% of all investors. So that's something that's really interesting. Now, the hard part obviously is how are you going to look at the skills of management? I think looking at skin in the game is an important start, or a good start, because you increase the chances that incentives are aligned. And then the second part, well, it's all about capital allocation skills. So it's all about decisions that management makes with what they will do with the money they earned. And that's something really important, because when at a traditional company someone becomes a CEO, well, often they become the CEO because they are the best sales guy, they are the best marketing guy, very good in product development and so on. But then they become the CEO, but they have no practical skills in capital allocation at all. So that's something really important, and that's also why the book The Outsiders, for example, is so good. Well, you want to have, or you want to invest in companies led by managers who have a strong capital allocation track record. Now, how can you do this? Well, you can't do this when someone from within becomes the CEO when it's its first time in his role. But what you can do is look at the track record of the business And when you have a business that looks like a wonderful company to you, and you see that the CEO has been leading the company for 10 years or even 20 years, and that the company did really well, so that it did better than the S&P, but also did better than its peers in the industry and so on. Well, in that case, it's already a very good indication that the company and the manager and the CEO is doing something well. So regarding management, well, I would say I look at two things. One, the skin in the game part. Are they invested in the company themselves? And then two, look at the capital allocation skills. So which kind of capital allocation decisions did they make in the past? And that's also what Buffett stated. Well, invest in companies that are led by managers who tap dance to work every year or every day. So managers will love what they are doing. They are enjoying themselves. They are not doing it for for the money or just for the money. They just love what they do. The business are a baby. So those are the companies you want to be associated with. So thinking about investing in a business like marrying a bit would already be really good for some people. Ask yourself the question, would I like to be associated with the company? Would I like to be associated with the managers? And when the answer is no, well, probably not a good idea to invest in the business.
Very much so. I love what I'm hearing, and I like the point you made towards the end, how, there are financial incentives, but what you're really looking for, I call it, we're looking for something that's not for sale.
Mm-hmm.
We're looking for somebody that's so passionate about what they're doing. And usually it's the original founder or a new CEO that comes in and gives the company kind of a second life.
Mm-hmm.
And that's somebody that will do the right thing when nobody's watching. And it's somebody that has true pride in what they do. I had a long discussion with Christian Billinger about it on this show as well. How once you find somebody like that, and obviously they have the technical, they have the method in place, and they think about the returns and so on, but they're really going way beyond what their role is to make sure that this business is success. And once you come across somebody like that, it's really worth watching and paying attention and maybe even participating in their success by being a shareholder in their business. But I think it's a rare find. And if you do find somebody like that, really, really pay attention. Pieter, we talked a lot about qualitative aspect of research, which I love, and I think it's very important. But I want to ask you about some of the quantitative criteria that you look at. Would you mind sharing some of them with the audience?
Yeah, sure. So first part of the book talks about the qualitative criteria. The next part are the quantitative criteria. So the key goal or the main objective there is to give people an entire framework for quality investing, to do it yourself. Well, what are some of the quantitative criteria mentioned in the book? We are talking about the book. Well, first things first, obviously you want companies to have a healthy balance sheet. So a healthy balance sheet gives them financial flexibility. So you want to invest in companies that preferably have a net cash position, or when they have, well, a net debt position that it's reasonable, and that the company should have no problems at all to pay off its debt over in the future. So healthy balance sheet, first part, really important one. Well, second one, the return on invested capital. You want your return on invested capital to be high and sustainable. So it tells you something about the capital allocation skills, and it also tells you something about whether the company might have a moat or a competitive advantage or not. So that's also something very important to me personally. Well, capital allocation and a moat are the two most important things regarding quality investing. Third point we talk about in the book is the high free cash flow conversion. So what you want is that most earnings are translated into free cash flow. And for example, the book Stocks for the Long Run, Jeremy Siegel, well, you have a study that basically concludes that companies that translate the most earnings into free cash flow outperform companies that don't by 18% per year, so 18% per year. That's a lot. So key takeaway here probably is that free cash flow is really important, and it's way more important than the earnings or the net income of a business. One side note to make here is that this doesn't go up. This isn't true when the company is still reinvesting everything back in the business. Because obviously then not all net income is translated into free cash flow, but that's not a bad thing. That's actually a very good thing, because that's how the compounding machines are created. So the wonderful companies with plenty of reinvestment opportunities. So in general, you want most net income to be translated into free cash flow. But when the company is still reinvesting very heavily in itself, well, in that case, you can probably take this metric with a grain of salt. And then the last part, the last quantitative part in the book is the attractive growth. So you've learned that in the long term, stock prices will always follow the evolution of the intrinsic value. Well, growth is truly essential to grow your intrinsic value. So we are looking at revenue growth, we are looking at free cash flow growth, and so on. So in the book, we are basically discussing these topics, giving certain criteria, certain metrics you can use to screen for those kind of companies, and that you hopefully this will allow you to find those kind of companies yourself.
Well, I obviously highly recommend the book, and you include quite a bit about also the quantitative side. So I highly recommend looking at that chapter for anybody listening that wants to have a kind of framework where to even start, what kind of businesses to consider. Pieter, I want to ask you about a point that I think doesn't get enough attention, which is the portfolio construction. And you have a reference in the book that I really liked. It made me smile. You talk about the chessboard reference that you borrow from somebody. Let's talk about buying, selling, trimming, position sizing, because finding the right businesses is only one part of our success. We talked about holding them, but how do you think of building a portfolio around some of those quality businesses that you come across?
Yeah, sure. It's a very good question, right? And probably, quote unquote, writing an investment case and deciding which companies you want to buy is the easy part. What's way harder is making a decision about when to sell a stock. What's maybe even harder is make the allocation decisions. So how much will they invest in stocks versus maybe some real estate, leaving some cash on the sidelines, and so on. And also the percentage you decide to invest in stocks. Well, will I give a 5% weight to this company? Will I give it a 3% weight? And so on. So that's something very important, something that is also very difficult. For me personally, what helps me is, once again, and I like Munger, try to use a lot of mental models, try to quantify a lot. And for me personally, I use a 15-step approach to analyze a company, and I give a company a score on each of the 15 steps. That can help to determine how many, what percentage you should allocate to every business. Regarding the chess example, well, it's indeed true, and I'll leave the chess example for the book just for fun, but you can make the same analogy for football, for example, or for a football field, or soccer, whatever you prefer. You have some in your portfolio, you probably want some defensive companies, some neutral companies, some offensive companies. So, for example, you can present it like a football field. You want the goalkeeper, so really the cornerstone of your portfolio, a very boring company, a very predictable company, maybe even a holding company with a very strong track record. Obviously, you also want some defenders. So once again, some more defensive companies, predictable companies that have done quite well over the past few years, and where you think that they continue to do well. And then obviously also still some midfielders, some attackers, maybe for a smaller percentage of your portfolio, but where the upside is higher. So high risk, high reward stock. And finding the good balance, it obviously, or it probably depends on what kind of investor you are, what's your investment horizon. Wouldn't you be able to sleep when a stock goes down 30% and so on? That obviously matters for answering the question how much you should invest in defensive stocks versus attackers or offensive stocks. So that's something really important. And when I probably think about some principles from me personally when investing in the stock market, I would say, well, obviously focused on quality stocks. So only the very best is good enough. I think another one that is really important is that you should always stick to your strategy. So it doesn't matter that much whether you believe in value investing, growth investing, or quality investing. But what really is important is that you stick to your strategy. So when things start to get tough, that you keep going. So it was Napoleon Hill, I believe, who said, well, the man who can do the average while everyone around him is losing his head will do really well in the end. I think that's exactly the true. So stick to your plan. Always focus on the quality with the 6 characteristics of quality. So you want a moat, you want skin in the game, a low capital intensity, and so on. And then, well, 2 final pieces. Well, let your winners run. Always let your winners run. I think that's the most important thing. When you would have invested in Lululemon 20 years ago, well, that's not. They are not listed 20 years, so I'll do that one once again. I'm not sure if they're listed 20 years.
It's been a while, at least 15, I would say, at least 15 years.
Let's take, just to be sure, another example. So when you would have invested in Apple 20 years ago, obviously you would be very happy, and you only need one.
Berkshire Hathaway.
Or Berkshire Hathaway, exactly. You only need to have one of those during your entire investment career to do really well. So let your winners run. And the other end of the story, well, when should you sell a stock? To me personally, there are only 2 reasons to sell a stock. It's one, that your investment thesis was wrong, so that you thought the moat is wider than it actually is. And second point, well, investing is a game of opportunity costs. Life is a game of opportunity costs. So when you find a more attractive investment opportunity, it can also be a reason to sell. But regarding selling, I'm probably very late. Always, I try to use a buy and hold strategy and keep great companies as long as possible.
I'll just mention again, none of the stocks we brought up a minute ago are recommendations, not investment advice. Do your own research.
Try to give some examples to make the concept a bit more clear, but I think that's exactly right. And that's also, for me, for example, you're sharing your portfolio, or I'm doing that. But there's one thing that's 100% sure, and that one thing is that some companies within the portfolio will be huge failures. So that's for everyone the case. That's even for the best investors the case. And I don't consider myself as one of the best investors at all. But always doing your own due diligence is probably the most important thing. And once again, you can borrow someone's idea, but you can never borrow their conviction. And when you just copy someone's idea, it will be very, very hard for you to persist when things don't play out. And that's probably the most important thing. And you have, for example, we talked about the psychological aspect. Well, you have, for example, James O'Shaughnessy. You probably know him, right? He wrote the excellent book, What Works on Wall Street. I really love the book. It's some quantitative methods that basically have worked on the stock market over the past 100 years. Well, what basically happened, he has a strategy trending value that outperformed the market massively, basically. He has built a fund based on that strategy. Well, after 3 years, the strategy really didn't perform well. He sold the fund because he couldn't handle it anymore psychologically. Well, you can maybe already guess the end result, but someone else bought the fund, kept doing what Jim O'Shaughnessy was doing.
Worked again.
And the fund did really, really well. So even someone who, I'm not sure if I can find it here immediately. So no, I can't find it. Doesn't matter too much. I was looking for those only listening, I was looking for the book in my library in the background. But even someone who wrote a book of 700, 800 pages about a strategy that works, well, even for him, it was hard to endure the strategy when things start to get tough. So that's something really important, probably.
The book you bring up, Jim O'Shaughnessy, What Works on Wall Street, it wasn't was one of the books that I had, and I still have it. It's a book I had on the shelf when I was a junior analyst, and I was a handful of books on a small bookshelf, and I remember going back to it for inspiration and ideas. But the big point that you make is that even if you find a formula, a method, and there are 1,000 ways to make money in the stock market, let's be honest about that. But if you find one that works with you, your personality, your clients, if you're managing other people's money, you will still have periods that you would say are underwhelming in whichever metric you use, your own expected return or the benchmark or whatever way. There will be periods when you will feel like it's not performing over that period of time the way I thought it would. And I think it's an incredible test. That's why I spoke about the journey itself, right? The drawdown is one thing, but seeing that other styles, especially in moments of madness, will perform way better than whatever you're trying to do, because the market is chasing the hottest thing in the moment. And these will be the times where you will look at what you're doing, and by definition, if you're not doing the craziest thing in the room at that time, your performance will not be as impressive as some of the hottest things. One last thought on that topic. Somebody brought up this quote from Peter Lynch not long ago in an article that I really liked. Peter Lynch said if he had one advice for somebody is not to own the hottest stock of the day. And it's such a powerful revelation, right? Like whatever you're doing, think twice if you want to buy the hottest stock of the day. One last big thought, overarching thought that I have listening to you about the portfolio and the reference to sports and assembling a team. And I'm thinking of the Moneyball and Billy Beane, and I'm sure you follow Michael Lewis and his books. But the one thought from that book was for me that you might have to make changes in your team, and your portfolio is sort of a team of players or pawns in a chessboard game that I will invite the audience to read in the book. A wonderful story. The way I look at investing, the families whose money I manage, they have an infinite investment horizon. There's no end to it in a way when you really think about it. But the assets we invest in, they're finite. And I think it's a big revelation that we should have, that a lot of the businesses we hold today might be around. Many of them will not be around, but even the ones that are around will be past their glory in the next 10, 20, 30, for sure 40 years. A lot of them will not be at their peak. By definition, we will have to make adjustments. And even Buffett, who is a long-term holder of businesses, has been trimming and selling out of a lot of businesses over time, or the ones he has held for a long time have become a smaller portion of his portfolio because the winners of today took on a much bigger role. So that kind of nuance and dynamic way of looking at wealth growth and preservation, I think it's very helpful. So even if you do have an open-ended kind of blue sky, infinite investment horizon, the assets you hold, they might not be with you forever, and in some cases probably shouldn't be with you forever. That's the kind of mindset that I have, and I like the sports analogy and a chessboard game. I think it's fascinating what kind of pawns, what kind of team members you would like to have. Billy Beane, one last reference here, he has this one moment in the book, he's a real character, that he didn't want to fall in love with his players, right? And I think that's a tricky place to be as an investor, because we do have an opportunity to develop a certain affinity for the stocks we hold, right? You followed the stock for 10 years, you met the management, you read everything about them. It might be really hard to part with, for example, Kodak, right? Kodak held the leading market share, case study, fascinating story for so many years in so many markets. The industry changed, digital camera disrupted the business, and consumer moved away, and Kodak really vanished from the earth. I mean, I think it might be still listed as a patent holding company. I don't know enough. Everybody do their own research. But what Kodak was, it's no longer, right? So you think this glamorous quality stock had to exit your portfolio at some point. There was no point in holding it all the way to zero.
Absolutely.
I think we touched on so many fascinating ideas that are in your book, and I highly recommend the audience to look up the book and also to look up everything that Peter shares. I mean, you've been so generous sharing all kinds of one-pagers, articles, write-ups, thoughts that really can jumpstart everybody's journey. I think everybody should be a business owner, even if they're not doing stock picking. I think there's a benefit in owning businesses in general, and the stock market provides that opportunity. So anybody that wants to know more, understand more, and even feel more empowered to ask questions to the financial advisor, investment advisor that's in your life already, I think you provide also that kind of knowledge that you sit in the room and you can ask what kind of businesses are in my portfolio and why, even if you're not the one picking individual stocks. Peter, thank you so much for today.
Absolutely.
What a pleasure.
Thank you. Had a wonderful time. Thank you for the invitation, Bogomil. I hope everyone learned something new, and I'm already looking forward to see you again. In sorry, I'm looking forward to see you again in Clusters or in Oma or wherever we are going to meet. And yeah, I would say to
Me too.
everything in life compounds. So let's enjoy it all together.
Very much so. Everything compounds. Friendships, relationships, and networks too.
Absolutely.
Peter, thank you so much for today. What a pleasure.
Thank you very much.